Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, September 23rd, 2022. I'm David Zarling. I'm here with Pratty, Matchmaker, Tulsian, and Ian Cowboy McMillan. The S&P 500 currently sitting at 3679. Plenty to cover this week. Probably going to be one of our most popular shows that we've ever done because the information is going to be fantastic. And we've had a lot of information from the market this week. Where do you guys want to start?
Yeah, I'd say, obviously a pretty rough week overall. More evidence that the bearish side of the market should be respected. I think that's my biggest takeaway from this week, and in particular, the last 2 weeks together.
You're saying sellers have control?
I think so. I think it's really hard to argue against that. Most indices back near their June lows. I think Pratty pointed out earlier that the Dow is somewhat surprisingly, or at least for me, the first index through its June lows. But yeah, and then quite a few sectors and sub-industries already through their June lows. So,
and we're recording this about just shy of 3 hours from market close on Friday, September 23rd. And so this could all change, right? We could reclaim the June lows today.
For sure.
And nothing says that has to stay that way. But economic law of supply and demand, that's not theory. It's not theory to say that more selling pressure than buying pressure and prices go down, and more buying pressure than selling pressure and prices go up. It's not theory that we would say that sellers have control.
And it's been this way for over a month. We had, I guess, a pretty decent rally early September for 3 days, but we are sitting on, over the last 5 weeks, S&P down 15%, NASDAQ down 18%. So as fun as that rally was, June, July, August, we can get to this later, the breadth thrusts.
We could talk about it now. I know we sent a market update to clients.
Last week, the breadth thrusts were legit. I don't think anyone's going to sit there and argue about the strength that we saw in late July and August from a data perspective. But now from a price perspective, we said it last week, and I think this week confirms it, that all of that bullishness that was built up has been wiped out.
Yeah, it's kind of like Lucy pulling the football, that old cartoon Peanuts, where we think we're going to have a field goal in our hands, and she pulls the football, and that's very similar to the price action that we saw both June and July, but then even more recently as early September, where we had breadth thrust meaning broad participation expansion. So the number of stocks participating to the upside had expanded, and they pulled the rug on that quickly. Because, we did rally using something like the S&P 500. From the June lows, we rallied almost 18% into the falling 200-day moving average. And that was quickly sold, quickly evaporated.
Rejected.
And that lets us...
as it was in 2008, not trying to draw a comparison. Although I will say, from a technical perspective, strictly talking about price behavior, big necklines being broken, being retaken.
For those listening, what's a neckline? If someone's not familiar with that.
So price, we're in an uptrend. I would call it the consolidation at the top. Stocks build a base, they go up, they build a top of consolidation, they go down.
Would the neckline be a horizontal price level?
Yeah, horizontal where price has been tested a lot.
Right, so you get a horizontal level where the buyers or buying outpaces selling at a
sold
certain
down,
price
sellers
point.
bring it down to a level and buyers come in and they buy it up. So obviously once buying has been exhausted, that, neckline, the term, and once that's been broken, that's when you usually see another leg down.
So an example maybe for those listening would be using a stock like Google, GOOGL ticker, originally around 125, 126, saw buyers step in there anywhere from January of 22 until April of 22, where it broke down. And then you establish another consolidation where buyers had been stepping in on that stock near 105. And we saw that fail on a pretty big stock. We saw that fail last week.
Very important stock.
And maybe that was a precursor to what we're seeing this week.
And you've already got the rest of the world who's broken its June lows.
Yeah,
Europe is pretty gross. Emerging markets, I know you've been throwing up the red flag on those for a long, long time, Dave. Pretty gross. Most foreign currencies versus the dollar, pretty gross outside of the Russian ruble.
Well, let's talk a little bit about it. Let's talk about a little bit about emerging markets. We've talked in the past about the makeup of emerging markets, right? Because it to someone who isn't in markets every single day, you say emerging markets, they're familiar with the term because that's part of the portfolio, not for our clients, but like the industry says you should own some emerging markets. Right, that's supposed to be.
They see this fund. This fund's been in my portfolio for 10 years because my advisor says it's supposed to be in there.
When we say that, what type of equities are in emerging markets? Like, where are we talking about? Are we talking
the emerging ones?
Well, I would argue this is an old joke. They're submerging that right now. Submerging markets.
Yeah, they are. I mean, so China and India are your big ones. Brazil, South Korea. I think those are your top four. If you're looking at like EEM, I don't know if that's like the official MSCI emerging markets top four. But when I look at, if you look at EEM weightings, I believe it is China, India, South Korea, Brazil. Could be wrong on that.
Well, and those as a group, if we were labeled,
India and Brazil held up well.
Well, they had. And we've even talked in the past on here on frontier markets, which would be, so if you were to think on a risk taking scale of equities, frontier markets would be some of your riskiest areas to take on foreign equity exposure, then emerging markets, then developing countries, then developed countries, United States being one of the developed countries.
Yeah.
We're seeing both developed and the risk, like high risk areas, sell off pretty harsh. Like frontier markets broke a pretty important
China, you look at Chinese large caps, are their lowest. Let's say we close right now, lowest close since March 2009.
Right.
And no, I would not take that as, everything bottomed in 2009. I wouldn't go, I don't know if I'm moving forward with that mentality yet. We'll see. They did consolidate down here. They actually went quite a bit lower overall, up to about 28% lower.
But this is why we don't marry modern portfolio theory and modern portfolio construction, right? Because you're supposed to be owning a percentage of that.
Something. China's supposed to be, think about that. 13 years. Over the last 13 years, Chinese stocks have gone nowhere.
Yeah. Pretty made 0% return.
Pretty big economy, pretty big influence on global markets for, I know the stock market doesn't represent everything, and I don't really want to get into a big macro conversation, but it's pretty tough.
No, for sure. And I think it's worth noting when international, which has been weak this whole, like when I say this whole time, I just mean since the correction has begun, and we can have a debate about when the correction began because everyone likes to focus on the major indices, like your S&P 500s and your NASDAQ 100s, right? They've been negative for the year. We know, right? We sent this in the update to clients. That breakdown wasn't confirmed until May, early May. And when we look bigger picture at what was happening underneath the surface, including international, 2021 could go down as one of the biggest distribution years we've seen.
Well, yeah, I think so. And there's some Monday morning quarterbacking that comes to it. I mean, you went through 2021, you watched indices like the Russell 2000 or Value Line Geometric or NYSE Composite consolidate
and sell off while the S&P and NASDAQ 100 moved higher, right? It covered a multitude of sins. Like the world, or I shouldn't say the world, United States citizens who watch things like the NASDAQ 100 and S&P 500 would not see that what's happening underneath the surface in 2021 was a pretty big correction and distribution happening.
Yeah. And you didn't know, right? Was it accumulation? Was it distribution?
Right. We don't know until afterwards.
We know now. I know one period we've talked about that's similar is 2015, 2016. Also a range-bound market, but that ended up resolving higher.
Right. It did, with the final shakeout being the Brexit vote. And, and then the election 2016. So that summer, that fall of 2016, some decent sized shakeouts. But you're right, heading into 2014, 2015, you had the S&P moving higher than consolidating, but underneath the surface was a stealth bear market. And out of that, we resolved higher. What's interesting about, and this is where I think you're going with this, is this environment somewhat similar in the sense that we had some sideways range since May that we've broken this week on the S&P 500. So now are we seeing a scenario where everything breaks lower?
And the evidence says, or the evidence continues to build, that the answer to that is yes.
Yeah, I mean, we can't argue with price. I mean, we can have as many opinions as we want, but in the end, trades are executed in price. Trades aren't executed in opinion. We don't get to call the trade desk and be like, well, actually, my opinion was this. No, it's the price that the trade is executed in.
You know how rich I would be if we got paid on our opinions?
Oh man.
That'd be so awesome.
So we've kept Pratty here hanging loose for a little bit here. Pratty, do you want to touch base a little bit on what we're seeing market wise? And I'll let you flow the way you want. Like, is there something you and the reason why we like having Pratty on here is he's a rising star as part of the adaptive team, and he's got great insights. And so I kind of want to let him have his piece on here. What are we seeing in this current market environment? Obviously, downtrending market, correcting market. What in your mind, Pratty, what are some significant events this week that are notable?
Yeah, I guess the biggest thing that kind of stands out to me is how the leaders got hit earlier this week. There were some stocks that were holding up pretty well while the market
very true
back about 15% or so. And, every day in the morning when those stocks were down, in the first 30 minutes, maybe the first hour, they would come in, buy them back up, stocks like Enphase, Celsius, Shockwave. But yesterday we had a bit of a character change there where they did buy them up. And by the end of the day, they closed near the lows of the day. So we're seeing a bit of a shift here where now even the leaders are also starting to come in.
Yeah.
I would throw energy in there too.
Energy overall as a sector, Ian?
Yeah.
No, and I think that's a great point. Pratty went through a couple names there that had been holding up. Our clients were aware of some of those or one of those. And it's interesting, to Pratty's point, I like that he used the phrase character change. And what he's just saying is, in the past, stocks like Enphase would be accumulated even in a down tape meaning when the indexes are down. And we kind of saw that change. And that was this week, right, Pratty?
Yep, this week.
And now we're seeing those areas also falling. And this goes back to the battlefield analogy of like the troops falling, the lieutenants falling, and the generals falling. And I almost hate using that analogy just because my younger brother serves. And so I don't like using that, but it is a great way to kind of explain where we're seeing the dominoes fall here. And so we have leaders that have now been hit. Ian, you brought up energy, right? That had been something we had participated in the past, even as early as the first quarter and a little bit here in the third quarter. Not recently, but
no. I mean, XLE below 80, I think, has been really hard. XLWAM, I mean, Exxon Mobil had stalled out up here at like this 93 level. So 94-ish. Yeah, and they finally came for a crude. I mean, crude has been, I'm going to be honest and say crude below 95. That consolidation that we had between 95 and 120-ish, 125-ish. Once we broke that, and then there was some Wyckoff shenanigans around that 94, 95 area, but I want to say that was late, like early August when we broke 94, 95 convincingly, and maybe we retested it or whatever. But again, and then even more recently, 85, which were some more like, I think those were the 2021 highs, 85, which is a pretty big level. We've been below that. Also some choppiness, but I mean, now it's 79. So yeah, it'll be a headwind for, I mean, really, even energy stocks a lot of them held up well, given the fact that crude's been in a downtrend since June.
Well, we saw solar, and Enphase was one of those, and solar stocks overall. And, you know, Pratty's point about former leaders now being hit. One thing I do want to pivot to related to that is a couple podcasts ago, we talked about the Titans and the areas, the big boys of the market, the Apples, the Microsofts, the Googles, the Amazons, the Teslas, the Meta. What are we seeing out of those stocks, right? These are stocks that compromise the majority of that's like something like the S&P 500. I mean, we're talking about 10 stocks that are a massive portion of the index. What are we seeing out of those?
I'd say for the most part, we're seeing most of these stocks making new lows. Something like Meta, this had already made a new low earlier this month. We're seeing Google make a new low. Microsoft's right there.
Yeah, I think that look pretty bad. Semiconductors look pretty bad. But Apple,
it's the final one.
I mean, it's been in a downtrend, but it's nowhere close to its June lows.
Right. And let's be honest. I mean, you've got Microsoft breaking its June lows. And we're using June lows because that's an important market marker. We've got Google.
Very important intermediate term. It would be, a lot of these stocks making year-to-date lows. A lot of areas making year-to-date lows.
And really, Apple's the one exception.
It is.
I'm going to say Amazon too. However, Amazon looks absolutely atrocious.
Yeah, I didn't even stop at that gap. I mean,
But
I would say Meta has looked. Facebook has looked the worst throughout 2022. It continues to. I mean, Facebook is $1 away from its COVID lows. So less than $1 away.
Really?
COVID lows. Yep.
So you're saying you could have bought Facebook at the COVID lows and you're there right now?
Yeah, I mean, you could have bought them at the 2018 lows and you're only up 10%.
So here we have an environment where we've talked about repeatedly in the past, falling 200-day moving averages. We negated any positive breadth thrusts that happened in June and July with negative breadth thrusts. I mean, and significantly, there's multiple days. It's not just like one day of negative breadth thrusts. It's 4 to 5 days. And I'm guessing today we'll record another one. Now, again, we're not at close. Significant selling pressure across all asset classes. Right now, we're talking about equities. but you only have a couple final pieces holding up, and that's Apple, and that's about it.
Yeah, I think there's a couple staples names out there like General Mills. And again, I haven't seen what they did to him today, but there's nothing. So, I mean, yes, cereal had a good week. And Cal-Maine Foods. I don't know what they make, but everything else pretty. And there's nothing that survived. This was, and going back to your point about breadth. Yeah. So again, if we go with the close rate here right now, it would be another 90% down day. And it would be the third minimum 80% down day this week.
That's a lot of selling.
So 290%. We had a 91% down day on the 20th, Tuesday. We had an 88% down day on Wednesday. We had a 78% down day yesterday. And right now, again, sitting on a 90% down. So a lot of selling pressure. Short term, you can argue that there's maybe a bounce around the corner.
I was just going to say, what you're describing sounds a little bit like capitulation.
It does. Okay. Yeah, let's talk about.
Yeah, let's talk about that.
Yeah, let's talk about what is capitulate. Is capitulation with what you say or what you do? Right? Because I think that argument has been brought forth this week.
It's what you do. It's how
I think that's what you do too. One of the big things. Let's talk about sentiment and all that. So, super hot topic this year this week. AAII survey. For some context around that, it is a survey of individual investors who are members of AAII. So does it represent retail? Does it represent mom and pop? Does your average person have a subscription to AAII and get on there to vote every week? I'm going to say no. But it is used to represent, quote unquote, retail sentiment.
Wait, you don't have a subscription to that?
I don't. I personally don't.
Pratty?
My parents are pretty into the market and never had a subscription. So,
Pratty, you got a subscription to that?
What does it represent?
No, I don't have a subscription either.
And it was at 60% for like the fifth time since the survey started, or some stat. Again, feel free to correct me. 60% of voters saying they were bearish on the market. Historically, it's a very high number. It's gone higher. I think it did go higher in 2008, but 60% has been some type of, what's the word I'm looking for? Contrarian indicator.
Okay.
And that was a big thing yesterday. But I would say, and Willie Delwish,
Milwaukee native.
Milwaukee, I think he brings up a really good point. And this goes back to, are you even doing what you're saying? And he says no. I mean, these same people are saying they're very bearish on the market, but apparently they haven't sold a lot of stocks. Again, I'm not the one that takes the surveys. So, but it's a super popular indicator amongst, I would say it's not just technicians. I would say it's a pretty big thing that gets attention across all practices. But they haven't sold any stocks. They say they hate stocks, but they apparently haven't sold any stocks. So I think it's an interesting conundrum.
Well, I think, for me, capitulation means you give up, right? That's the very definition of whatever the scenario is. I'm done.
Yeah.
And in March of 2020, we saw capitulation. Everything, all the correlations went to one. Correlations meaning everything moving in the same direction. Treasuries, stocks, commodities, you name it, down. That's what I view as capitulation. I mean, whatever. If people want to survey people, but we've seen surveys that fail continuously because people say what they want to say, but then can they actually do the things they say? And I would argue no. We're failed as human beings. We don't do what we say. We want to do what we say, but we don't. And so if you're caught,
and I do believe that investors are scared.
For sure.
The last 3 times investors were scared. They got screwed. If you sold here right now at 20%. And I think that's in the back of a lot of people's heads.
Yeah, it could be. I have no idea. Like, I don't know what other people's minds are. All I know is what price is showing me.
I don't have to worry about that.
And what price is showing me is supply is outpacing demand for equities. Supply is outpacing demand for bonds. Supply is outpacing demand for commodities. Supply is outpacing demand for crypto.
Foreign currencies.
We are at a place where people want out. And I don't want to say that this is the capitulation event, but we're closer to it than we were before. And so there's a scenario here. There's a scenario here where, like, for example, the put call ratio, meaning the amount of bets being placed in a ratio fashion of downside versus long side, downside versus upside, has continued to increase throughout the year. So does that mean we're out of the woods? Absolutely not. Have we reached capitulation? I have no idea. If we're breaking below June lows in a lot of different things, until we recapture, it's a math problem. It's pretty simple math. Until we reclaim the June lows, this market is guilty. Like, let's not overcomplicate.
You make a good point, especially in put the call. Is it because people are buying lots of puts, or is it because
they're not buying calls?
Yeah. Is it because there were 3 puts in 1 call bought, and now it looks like it's that's obviously an extreme example, but this 3-to-1. I mean, that mindset can absolutely take place. And it goes back to your giving up. Now, also giving up doesn't mean that it ends right away.
Correct. And every bear market is different. I know you had a nice piece in the write-up for clients regarding every bear market is different. I think of, for example, 2008, Lehman Brothers bankruptcy, where that happens in relation to the actual market bottom is fascinating. Because I'm telling you how negative sentiment was going into the Lehman bankruptcy. It was pretty doggone negative.
Into or following? And that's a legitimate question because
into.
Okay, so it was already horrible.
Well, yeah, because you already had the market down almost 20%. And you get the Lehman bankruptcy and sentiment is negative, but there was also this interesting dynamic of investors believing, that was priced in. Like, you have a 20% correction, you announce the Lehman bankruptcy, and that obviously this is what we were discounting this whole time.
Okay, so what would you say would be the equivalent of, Sunday night a bankruptcy gets announced?
Like now?
Yes.
Ooh, that's a great question, because I don't think we've had something yet. Like, I don't think we've had it could be some currency breaks. It could be some I
don't think the crypto fund blowups are worthy and like big enough. That does not affect Main Street. That does not spook Wall Street. Because 3 Arrows Capital blew up. I don't think mom and pop care about that.
I don't know. I mean, they might care about it if it's trillions of dollars that have counterparty risk. I truly don't know what the counterparty risk are on some of these crypto exchanges. I really don't. They had yield farming and yield staking that was 17% that was coming from somewhere.
Yeah, but that is not what John and Jane Doe have in there.
But it's not about what John and Jane Doe care about. It's about what the Goldman Sachs of the world have on their books. Like it's not John and Jane Doe that moved the market. It's the big
I meant
boys.
more from like a sentiment.
No,
that's like the blow ups in other asset classes like crypto haven't affected your average American. Like if you turned on the CBS Evening News and they said, "Oh, Lehman Brothers went out of business."
I guess to me, when I look at 0809 and the correction that took place going into the Lehman bankruptcy, we were down 20%. It's not like that was a mystery. It wasn't like, oh, wait, what? The market's down 20%. No, people knew this. But the sentiment at the time was, oh, this was priced, like that's priced in.
And so then Lehman happened 08, like follow 8?
The Lehman bankruptcy, let me get the exact date. Let me use my Google calculator. September 15th, 08.
So you would say that's what spurred the, oh my gosh. Because that was like the waterfall after that.
After that.
Okay.
But going into that, you had already had the market down 20+%.
Yeah, it already looked horrible.
And there was a lot of people that in that time frame from an institutional level were saying this has been priced in. And that simply wasn't true. We then waterfall down. And I'm not saying it's crypto. I have no idea. All I'm saying is we're in a corrective period now. We haven't had that announcement of what there hasn't been a bankruptcy. There hasn't been a currency crisis. There hasn't been some type of default. It just seems like, based on what we're seeing out of the currency markets, what we're seeing out of the equity markets, what we're seeing out of the bond markets, there are things that are breaking. I don't know what that thing is. And I don't need to know. I've got price.
Credit, yeah. I mean, credit has been breaking. Clearly, treasuries. And the fact that there's still zero interest in outside of today, I mean, yeah, they got a decent bounce today. But let's be honest, the fact that during this whole thing, no one has wanted to run to treasuries.
Well, and that's a good point, because there are people who would say, well, why don't we just own bonds? Well, bonds are down 40% since August of 2020. You're telling me that for our clients, we should be owning bonds during that time? That's a rhetorical question. I'm not saying.
Well, and that's the whole, and it's not worth cash flow, right? Because you're like, okay, $100,000 portfolio loses 25 grand in principal, but congrats, you got your $2,500 in coupons. Right. No one's doing that.
Well, and year to date, like if we look at since January of this year, treasuries are down. It's 27%. Like it's the worst start on record for 10-year yields.
Horrible. And Pratty, right? And the yields and where we are inverted and what, Pratty, what's the 2-year at right now? It's above 4%, right?
Yeah, we crossed above 2%, 4%.
And yet you've got a 30-year at 2.5 or 3.5. I'm sorry. Well, it's 3.6, but
yes, you have a yield curve inversion on our hands. You've got a situation where stocks are down, bonds are down, commodities are down, crypto is down. There is no place to hide. Correlations go to 1. That's the environment we're in. And that's why you can't just pile clients into that sector. Like you can't just take clients and put them in bonds because that quote unquote, that's what's worked for the past 40 years. That's not how these things work. Yeah, let's talk about gold.
Right. Gold goes in that same bucket of, if inflation goes, bonkers and the world goes to heck in a handbasket, gold, like I can somehow taking these gold bars into town, I'm going to be able to barter for goods or, whatever is the mindset there. Yeah. And a lot of this is dollar strength. You've got gold breaking a pretty big level this week at 16. Let's call it 1670 an ounce.
Well, isn't that hilarious? In the environment where not many months ago, there were many people talking about the death to fiat.
Talking about the death of fiat, I mean, well, certain communities,
certain currencies for sure. But if you're talking about the dollar on a trade weighted basis or versus,
and that was the whole. I mean, that was the big one of the mantras of the whole crypto community.
Correct. Was that somehow the dollar was going to die? Well, guess what? You'd been better off owning the dollar than your crypto, and that pisses people off. But I don't know what to tell you because the chart and studying supply and demand tells us those things are carrying more risk than the dollar right now. And I guarantee you that there's people that just makes them gnash their teeth, that they cannot understand what kind of world we would live in, that they would own the dollar over Bitcoin. I don't know. Tough nuts. I don't know what to tell you.
Centralized currency.
Yeah, right. Decentralized. Is it really? And this goes back to what era are we in? We're in the era of lies, where people get to say, oh yeah, we're decentralized, but wait, you have a bank charter? That means you're centralized. So I don't understand the whole, like, you get to say you're yield farming. It's a clever way to say it, right? We're out in the field and we're farming for yield, but it's not there. It doesn't exist. It's like we are in an era of smoke and mirrors. And that's why price is so important at this point, right? Because if you're going to try to do this on the narrative, you're going to try to do this on the fundamentals, it's going to be very, very difficult. Because, for example, in the client letter, we talked about if we're in an environment of rising rates from this point for the next 35 years, that flips a lot of things on their head, whether it's portfolio construction or financial planning. It changes lots of things.
All right, so we've hated on our home team, U.S. Treasuries. What about, I mean, is there anywhere? I mean, junk bonds? Junk bonds?
No, junk bonds are risk off too.
Oof.
They're breaking to new lows and
lows below their June lows.
And that's a risk off characteristic.
And there's another asset from a technical perspective over the last 2 days. The list continues to build again from a technical price behavior perspective. The only thing left is COVID lows. Like maybe these fail. I'm totally willing to accept that. But the next level of support on many, many assets and individual stocks out there is March 23rd, 2020.
And does your advisor, does your portfolio have a process for that? That's really what this comes down to, is what's your process for dealing with these type of environments? And that's where I kind of want to weave Pratty in here. And Pratty, I give you a lot of credit for listening to Ian and I just go off the rails here on some of our agenda items. But you brought up something interesting in our pre-market, or our pre-podcast call about things that we're seeing in this current environment. And I kind of want to, there's a reason why I gave you the nickname Matchmaker today. Do you want to talk about something that you're seeing in this market that I'm not necessarily, maybe it gives us an advantage, but there's different tools we can use. Can you talk about that a little bit?
Yeah. So, with the dollar kind of, I guess you could say it's definitely in an accelerating move higher, right? And in that move, there's going to be counter trend moves as well. So if you look at how extended the dollar has gotten from a moving average. So for example, if we just look at, how extended the dollar has gotten from its 50-day moving average, you'll see that, it's actually, it tends to get about 4% extended from its 50-day moving average. The last couple of times it topped out in May and June. Right now it's kind of sitting there again. So that would suggest maybe the dollar has some potential to roll over again in the short term. And that would, again, go back to the point earlier, if we are capitulating, do we get some sort of relief? But then if you look at a longer term moving average, something like a 200-day moving average, you'll see that every single time the dollar topped out in May and in June and July, the dollar got more extended from the 200-day moving average each time. So in May, the dollar got about 8% extended from its 200-day. In July, it got about 9%, and right now it's about 9.5% extended from its 200-day. And if you zoom all the way out, historically, the dollar tends to get about 12 to 13% extended, and we'll have these charts up on Twitter for anybody who wants to see as well. But this would suggest that there's certainly evidence on a longer time frame for the dollar to continue going higher all the way up to that 120 target that we've outlined before.
No, exactly. I mean, and what you're describing to me, it almost sounds like the 200-day potentially is accelerating upwards. The last 200 days of information is actually accelerating along with price to the upside.
Right. And each time the dollar makes that extended move, it gets more and more extended from the 200-day.
No, that's good. That's good information. And especially for one of the strongest currencies on the planet. And one of the others, and maybe the only other strongest currencies, Ian, that you highlighted that would be a surprise to many. We've got the dollar. What else? What other currency we got out there that would probably surprise most to know how strong it is?
The Russian ruble.
Yeah.
Yeah. Stronger than the dollar.
Yeah. Isn't that amazing? So you have so much dollar strength out there when we compare it against so many different currencies. I'm not being facetious. I'm being sincere when I say, when we look at the major currencies, whether it's the euro, the yen, the British pound, which the British pound is, I don't know what's going on there, but I don't know if I ever repeated the Soros breaking the bank, but the Canadian dollar, the Swiss franc, the Australian dollar, the New Zealand dollar, these things are getting hammered versus the dollar. And here you have the Russian ruble breaking to new highs out of a consolidation. So do we see the dollar continue to rise from here? Well, we broke out of this massive range that goes back in time that does measure to 120. And that's an interesting environment. When you're in those type of environments of everything weak, dollar strong, are there any tools, Pratty, as far as from a relationship standpoint, pairs trades, those types of things that we could be looking at to see, is there any potential advantages from looking at that type of information? First of all, what is a pair trade?
Yeah.
And then what are some things that are unique that you're seeing from a pair trade perspective?
So pair trades are definitely something that, are new to me this year. And obviously I knew what they were before, but I never really even considered, where they would have a place in our portfolios until this kind of environment. And so I guess the beauty of a pair trade is that when you have a broad market that's moving lower, you can get long the relative winner and short the relative loser. And if the entire market goes down, your long might go down, say, 5, 10%. But if you're short the right relative loser on the other side, the short could be down 20, 25%. And, even though your long lost money, your short would have made more money than your long lost, if that makes sense.
No, you did a great job on that.
Now you've just made money in a environment where broad markets are lower. So you've essentially created a bull market by getting long one stock and getting short something on the other side.
Do you have an example of one? Is there one that we could take under consideration for this podcast?
I think the easiest one to probably look at is just something like Tesla versus ARK. So
okay.
We know ARK's been in a bear market since February 2021. But if your universe of stocks was ARK and you got long Tesla and you shorted that universe of ARK, you would have made money the whole way up.
No, and especially considering out of August, not surprisingly, starting August 26th, which is a date we've highlighted here on the past as far as being that downward breath thrust following Jackson Hole. From that period, you're saying if I was long Tesla and I was short ARK, there would be outperformance versus the S&P 500 because of that relationship.
Exactly. And I think the best part about pair trades is that they really let you control your risk in a different way. So obviously the absolute return might not be as great to the upside, right? Because you're short something that's going to be losing money if the market's moving higher. But at the same time, when the market does go lower, for example, today, Tesla versus ARK is down a little bit, actually. It's only down 1.67%, while Tesla's down 4.5%. So you can really, mitigate the volatility with pair trades.
No, for sure. I love it. I think that's a great thing that you've learned over this past year. That's great. So we've talked stocks, bonds, and we touched a little bit on commodities with the gold comment. But let's talk about gold. Like, sincerely understanding what we're looking at today when we look at gold futures or something like GLD. I mean, Ian, this is a pretty big development.
That's horrible.
Like
silver too.
Yeah. I mean, gold is supposed to be the risk off trade, right? This is where you go when things are bad. It's supposed to be the inflation trade. This is where you go when there's going to be massive inflation. We haven't really seen that, have we?
No. Inflation has not worked out. As ironic as it sounds, inflation and the hysteria around it, valid or not, I think a lot of it is valid. I mean, inflation is real. I think there's anything denying that most people feel that. But it has worked out for nothing and no assets except for the US dollar, which is, I think many would argue, is the cause of all of it in the first place. There's too many of them.
And it's the big dichotomy, it's the big paradox, and it's the big irony.
And isn't that just such a market thing to do?
Yes. Like, markets are going to do what markets do, and that's confuse the majority. And here you have an environment of supposed high inflation, which we know what follows inflation, typically deflation. But the world would tell you, the textbooks would tell you that when high inflation is upon you, you shouldn't own the dollar. But here we are in an environment where the dollar is the only safe haven other than the Russian ruble. There's really no way to express that investment-wise in the U.S. to buy rubles. There's really no way to do that.
They took U.S. or Russian ETFs away from us, Russian stocks.
Right. And all those are, those would be down too, right?
And the rest of the world, right? No one can buy Russian assets, yet their currency
continues to go to new highs.
Yeah.
Out of a big consolidation. So here you are in an environment where you'd have been better off buying the dollar relative to other major currencies than equities, than bonds, than commodities. And even like we talk gold, you mentioned silver, those are our precious metals. We have economically sensitive metals as well.
Copper bad, tin bad, aluminum. These areas, we talked about Q1, had, now what look like they're kind of cyclical blow off tops.
Yeah, that's a great way to put it. Like Alcoa would be a good example of something that's economically sensitive company, cyclical, getting hammered.
Freeport McMoran.
Yeah, Dr. Copper, FCX. You look at a chart of something like FCX, Freeport McMoran, and it is very hard. Well, I don't even know if very hard is the right. Right now, you can't see the bullish thesis.
No.
Where's the bullish thesis on this? My only bullish thesis, and what do I mean by that is, we're always open-minded. We're not sitting here marrying one direction. We're open-minded. And in fact, let me ask this question to you guys. What would make you open-minded to upside from here? How does this take place? If we're going to get upside in equities or bonds or stocks or, you name it, what does it look like?
For me, it's recovery of some type of level with a really solid breadth thrust. I know one scenario you've brought up a lot to just be on the lookout for in the coming weeks and months is, let's say we take out the June lows and recover them. And it happens with solid participation. Is that something that kickstarts a move higher? Or is it another Lucy like June, July, August? Move over to 3,900? I think really, when we're talking big picture, Dave, really for me, where we stand now, and if we move lower, this level absolutely changes. But right now, it's 4180.
Yeah, right. You're highlighting the current range. Mm-hmm. The current range, right? Because let's just use the S&P as an example. The closing low from June on a daily basis was 3,666. We're currently sitting at 3,671. If we hold this, you're just saying the thesis of price returning to 41.80 still exists. The market is still suspect below 41.80. But if it reclaims that, the thesis of higher prices from there for that point forward makes sense.
I think so.
And that's just math. And that's a non-sexy answer. But I like it because you're just saying there's price levels to deal with here. Now, let's say we exceed 3,666 June lows on the S&P 500. There is a scenario where we've stacked a lot of firewood from a put-call ratio perspective. If it is true, in fact, that people are getting really, really short right here, which I don't know why anybody would be getting short into potential support, but that's their prerogative. But you're stacking up future buyers. And from a seasonal perspective, right, we're heading into the final week, 10 days of September, notoriously bad in a midterm election year. October can be, I don't want to say equivalently bad, but it's not strong until the end of October. But there is a thesis that exists where we surpass the June lows in something like S&P 500, reclaim them, and then head on to higher price levels going into the end of the year. Now, whether we get back to, 4,800 seems like a long time ago on the S&P 500. So whether we get back to that or not, I have no idea. But there is a scenario where we move higher late October into the end of the year. But in the end, the only thing that knows that is price.
Well, and obviously 48,100 is not, like I said, it's, if we move lower, say we end up at 3,300, 3,400.
Okay.
Pre-COVID highs, dead smack middle of this. September.
Yeah, I know what you're talking about.
Yeah, you pull up a chart of the S&P, or you were there and traded it. Everyone remembers September, October, November 2020. We go back there. Clearly, you fall another. That's another 8%. No one, I'm not sitting here saying, well, it's still 41.80 until I'm willing to buy stocks. I think that would be a little too late.
Right. You let the market create some structure for you to work with.
But then I think that, again, that's probably still 3,600. Are these June lows at 36? Would you say 36.66?
Right. Yep.
Yeah, somewhere in there. We'll call it 3,700. You get you come down here, 3,400. You get a move back above 36 or 3,700. We'll see. Now we're getting into trying to talk about potential situations, months in advance. So, gosh, no, I know we could cruise right through 3,400 towards 3,000. Who knows?
Right. I like, yeah, exactly. I like the way you're talking. You're just saying we're not here to have a prediction. We're here to have a plan.
Mm-hmm.
And what's our plan? What's our plan below 3,666 on the S&P? What's our plan if rates are above 3.4? What's our plan if gold is below 1,700? You have to have a plan. And if you don't, then that's a dereliction of duty, in my humble opinion. And so that's why we use price. And we have to be open-minded at different scenarios. Do we break back below 3,666 and then reclaim it? And then what? And so you're working through these different scenarios. You're letting price dictate those. That's why we call ourselves Bayesian, right? We're scientific in our nature. We have theses that are developed, and only price can confirm or deny those theses. And right now, the thesis of stage 6 contraction, meaning bonds down, commodities down, stocks down, it's alive and well, especially after a week like this week.
It is.
And I don't even know if we talked about crypto yet.
Yeah, we included it in our, we haven't really talked about it, but we've mentioned that it was, just as abysmal.
It's right there. Something like Bitcoin, 18.8, Ethereum.
June lows, yeah.
Right. So those are also potential things to pay attention to. But from an evidence standpoint, we continue to see a weak environment across all asset classes. Selling pressure is abundant. There's really no other information than that other than our clients know they're holding high levels of cash because of this environment. Whether that continues in the next week will be to be determined. We've bumped up against the end of our time together. Anything else you guys want to touch base on before we wrap it up?
Nothing else for me.
No, I just, again, to reiterate that everything that you would want to see working is not. I cannot think of anything to really put in my bullish bucket of evidence other than kind of what you said earlier, Dave. We're closer to the bottom than we were yesterday. Closer to capitulation than we were yesterday. So I don't know when that happens, but we're getting there.
Well,
it doesn't continue, but
right.
We are closer.
And these things happen quickly, right? You could see a scenario where we just had this week happened quickly. You have a consolidation here before any decisions made, either which direction, down or up. But as you said, there's not a lot to point to from a bullish perspective across asset classes. And that's why I think you wrote so appropriately in the client update, cash is a position too. Nothing wrong with that.
Is.
Nothing wrong with that. Cash is a position too. So I appreciate you guys. A lot of good things covered today. Thanks for being on, Pratty. Thanks for being on, Ian. And thanks for everybody listening. And if you get a chance, whatever platform you're on, give us the highest ranking. That really helps us out. We do these for you guys, both our clients and our listeners. And there's no cost to you. If you could repay us with a high ranking, we'd really appreciate it.
Have a great weekend, everyone.
Have a great weekend.